So if you look at this chart here, this is the year-on-year global money supply versus Bitcoin. And you can see they're hugely correlated. Now, what's interesting, you see the tops of the charts, they're all missing because the scaling doesn't work. Because of the technological trend adoption, when you get the rallies, they tend to massively overshoot, even versus where liquidity is. And that extra is the extra trend that drives the markets forward over time. Now, every time we see these trends, the boom and bust, everybody shouts scam Ponzi, but that scam Ponzi phase is actually just driven by the monetary tightening cycle. Now, there is a lot of speculation in crypto. I get that because there is in most new technologies, we get that in technology stocks themselves. So right now, we are at the bottom of the monetary cycle. Going forwards, we know the Federal Reserve is going to start increasing rates at lower increments. I don't think they go much further than maybe this 50 now. Maybe they try and eke in another 25 and try and keep rates stable and then wait for CPI to fall below Fed funds rates, which I think happens March, April. So I think next year is a game of dramatically changing liquidity conditions.
Anyone who ignored Bitcoin over the last 7 days would think that not much occurred if looking at the total price movement. Those paying attention might still be dizzy from the roller coaster ride. Optimism early in the week reversed, with Bitcoin's price settling in just below $17,000. On a relative basis, Bitcoin's 7-day performance against the US dollar was third among the top 20 cryptocurrencies by market capitalization. Ether finished just in the middle of the pack, declining 5% over the last 7 days. Hello and welcome to Money Talks. In today's video, Raoul Paul runs us through his big picture views on digital asset markets, the macro landscape and network adoption, and Bitcoin price action, where we've come from and where we are going.
Anyway, too early to tell doesn't really matter for this point. This point is we're at the low point in the cycle. I think inflation is lower. I think the crypto markets are going to be explosively better this time around. We're also seeing a lot of interesting things like the RSIs, weekly RSIs in Ethereum and Bitcoin are right down at levels that have always seen reversals. We're seeing it with on-chain activity. We're seeing it with minor capitulation. We're also seeing it with volatility. The 30-day realized volatility of both ETH and Bitcoin is at levels that always precedes the large rallies and the big reversals. So I've pretty much got everything in place. Is it possible to get some other down leg? I doubt it, unless something can drive bond yields high. And I just don't see that outside of a temporary blip because one of the inflation numbers or one of the employment numbers is skewed somewhat. So I don't see that happening. So I think we are moving higher. I think ETH based in June, and I've said that for several months now, in fact, since June when I started adding to my positions. The bottom of the cycle is always the it's a scam, it's a Ponzi, all the media hates it, everybody throws shit at each other online, everybody's looking for blame, looking for scapegoats. We are exactly in that point now. It is ugly out there. And that ugliness out there is a real measure of where we are in the cycle. So we're at the despair and anger phase. And then we have the acceptance phase, which is the boredom phase, which I think we've rolled into, where prices don't do anything for a while and everyone starts getting fed up and moves on elsewhere. You can see artificial intelligence is getting people's attention just when they should be looking at crypto as well. Don't forget, artificial intelligence is not really investable for most of us because it's all VC, while crypto is real-time VC that we can trade, which is part of the magic of it.
BTC's chart doesn't offer much by the way of short-term optimism. Its relative strength index has fallen near 40, implying that BTC momentum is essentially neutral at the moment. The volume profile visible range tool shows significant past trading activity and price agreements between $16,500 and $17,000. The combination of these factors sets the framework for BTC to trade flat in lieu of a new catalyst.
So we're at the blow-up phase, the FTX scandal. Now, I've seen it with Mt. Gox, I've seen it with Bitfinex, I've seen it every single bloody cycle. And this time around, everyone's like, oh my God, it's the end of the world. Yeah, it's every time the end of the world. And guess what? It's not. It's never the end of the world. People say, well, nobody's ever going to come back into this market. Well, I've been around. I've been around the block a long time. I've been 30 odd years in financial markets, and I've seen this with hedge funds. Long-term capital management, the biggest blow up of a hedge fund in history, the Fed had to bail out the whole system. What everybody shouted at them, they're a Ponzi, they're a scam, they're over leveraged. Hedge funds are uninvestable. Net outcome? The net assets of hedge funds went up 5x over the next 7 years. Why? Regulation. Regulation appears to have cleaned up the space, and then people feel much safer to come in because the institutions are waiting.
Month-to-date performance among CMI sectors shows that the CoinDesk Currency Index has led the way, although in this case, leading the way really just amounts to decreasing by the least. The CoinDesk Computing Index declined the most, down close to 14% month-to-date.
So, where are we in the crypto market? The most important thing about understanding crypto is understanding how to price it. And how I price crypto is essentially two major factors. One is global liquidity, and I use Global M2 as the main understanding of that. And then there's and that's the cyclical element. And then there's the technological adoption, which is the long-term logarithmic trend. So let's deal with the cycle first. The cycle is what causes all of the pain. And I've been in this space since 2013, and trust me, I know pain. The first time I bought Bitcoin was at 200. It went up to, I think it was 1,000, then back down 85%, languished for a year or two, and then went up 10x from my entry price where I sold out. And then it came back down again after going up another 10x, then it came back down again. And I've seen these cycles. And at first, a lot of people correlated them to the Bitcoin halving cycle. And I think that's probably coincidental. And it's the fact that the economic cycle works in about the same time horizon, this 4-year period after 2008, that the Bitcoin halving cycle does, because it was born out of the crisis. And really what I think is going on is it's the debt refi cycle, because there's so much debt in the global economy. And what happens is they try and tighten rates, and then you've got to refi all of this debt, and rates come all the way back down again, liquidity comes back. And I think the stasis, the natural tendency is for there to be ongoing stimulus, because a overly indebted economy, and if you think of GDP growth being population growth plus productivity growth, well, with aging populations, that's out of the equation. And it seems that immigration is a political no-go, particularly with real wages so stagnant. So then you've got productivity growth. Now, that's not been growing either. So the only way of funding GDP has been debt. But now it takes $3 of debt to drive $1 of GDP. We kind of get to the end game, and there's just so much debt out there, it never gets paid back. So the only way of running an economy now is allowing for the increase in debt, but what services the debt is the cash flows. So therefore, GDP growth must be higher than debt growth. If not, you need to run negative real rates. GDP growth, because of aging populations, low productivity, has come down too low to service debt growth, and therefore you run negative real rates, quantitative easing, and other such stimulus. That is the way the world works.
According to recent data, the cost of wholesale products excluding food and energy has decreased. This trend may be due to improved supply chains and reduced demand, resulting in higher borrowing rates. It supports the claims of economists that commodity prices have started to decline. The Producer Price Index also indicated a slowdown in inflation. The 0.6% increase in the cost of final demand items was reportedly responsible for the increase in PPI, excluding food, energy, and trade services. In October, the PPI increased by 0.2%, lower than the 0.4% consensus estimate, and annual prices fell from 8.4% to 8.0%. The crypto market appears to be ignoring worse than expected economic events and continues to fall in response to Fed and ECB rate hike decisions.
So in the cycle, which coincides with the Bitcoin halving cycle, is the global liquidity cycle. And that's the central banks creating liquidity for the markets and for the economies. So what they tend to do is if the economy gets too hot, they tend to raise rates, liquidity comes down, they withdraw liquidity from the markets, take away QE. We've seen this several times before. And what happens is asset prices come down because they need stimulus. So once you take asset prices down, what happens is the economy starts headed towards a recession or goes into recession, and the monetary easing comes back again because that's the natural state of affairs. So that's kind of how the world sets up. And right now, we're in the situation where we've got massive monetary tightening. Now, monetary tightening has brought down cryptocurrencies, not as bad as they were last time, certainly not the majors. I mean, Bitcoin, ETH, they got down to 75%, which is, ETH last time, the last cycle in 2018 was down 95%, much like Solana is now, more on that later. And Bitcoin was down 85%. So we're seeing a less dramatic tightening because there's more people involved in the network, which is the growth of the network is more robust over time. We'll come more into that.
Technical indicators such as relative strength index and moving average convergence divergence are commonly used by traders to analyze the price movement of an asset and predict future trends. These indicators are currently showing a bearish trend for Bitcoin, indicating that the price may continue to fall.
I also have charts to show that too. I've got chart of Global M2, and you can see it versus ISM. ISM leads it, inverted on this chart. And it says when ISM starts falling, Global M2 follows and turns around. And that means because ISM is saying growth is falling and therefore monetary liquidity needs to come back in to save and manage an overly indebted system. So that's the typical state of affairs. We're exactly at that kind of turning point. So that's where we are in the monetary cycle. I think we will see inflation fall much faster than people expect, and therefore stimulus will come. And I think the Fed are going to think or look somewhat stupid by about June, where I think inflation is going to be down closer to 2%. I mean, the year-on-year rate of change of oil prices alone is probably zero right now. And if oil goes to $60, where I think it goes, and we get into March of next year, that was the time from the Russian oil crisis premium of about $120. So oil will be down 50% year on year. That's incredibly negative for an inflationary environment. Owners equivalent rents are rolling over, and eventually wage growth will start slowing down dramatically. So my bet is we probably get negative rates back in the end of 2023. Sorry, not negative rates, negative inflation, 2023, 2024. I think the roadmap that we use for this is the 1940s and 50s and not the 1970s that everybody thinks. So the 1970s was the only example in history where inflation came up, came back down, didn't go all the way back down, then shot up again. I think that was driven by demographics, and the Federal Reserve are fighting an old ghost, and it's not the ghost that they should be fighting.
So, do you agree with Raoul Paul that Bitcoin and Ethereum's price will move higher from here onwards? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video. Thank you so much for watching.